Thank you for attending the latest installment of the Options Industry Council's webinar series, Cracking the Code, Taking the Mystery Out of Option Symbols and Chains. My name is Alexander Osinga, and I'm a staff member here at the OIC. I'll be guiding you through today's session. In today's webinar, we will dive into market quotes and other important data essential for investors trading options. We will unlock the mysteries of option symbology, cycles, quotes, and change, which can be difficult to decipher, especially for those who are new to options. Our presenter today is OIC's very own Mark Benzequin, who is a Senior Investor Services Specialist for the OCC. He is responsible for providing support to a comprehensive options resource center that provides information and education about options and supports all products traded on all OCC participant exchanges. Mark began his career in options with Stafford Trading and before transitioning to brokerage operations, but Mark spent most of his career in the trading pit, gaining special insight into customer order flow and trade execution. We welcome Mark as an OIC instructor who brings a breadth of options experience to the table. And now, ladies and gentlemen, Mark will bring you your topic today, taking the mystery out of option symbols and chains. Mark?
Well, hi, Alex, and thank you for that introduction. And ladies and gentlemen, thank you for, as Alex had said, taking the time out of your day to join us. If you're anywhere near the Chicago area like we are, it's a gorgeous day outside. So I certainly appreciate you joining us here inside to learn more about options and further your option education. You know, Alex was mentioning the survey that we have at the end of our presentation. The reason that it's so important is one of the things that we notice about our survey is we've got a lot of beginners in options lately, and which was the reason for last week's fundamentals program, Options 101 Strategies Made Simple, and it's also the reason for today's subject, Cracking the Code, Taking the Mystery Out of Option Symbols and Chains. And the reason being is in the Investor Services Group, we receive a lot of emails and a lot of chats from online about people asking about different expiration periods, different series, what's available to trade and what's coming on the horizon to trade, as well as learning about their broker's option chain platform and wondering about all the information there. So, you know, we took your suggestions, we took the fact that we've got a lot of beginners, and we've got a great program for you today, so certainly welcome. Again, thank you, and let's go ahead and get started with a bit of legal issues that we need to talk about. Options, as you know, involve risks and are not suitable for everybody. If you're new to options trading or if you're just getting started, your broker is going to need to approve your account for options trading, and part of that approval process is going to be your acknowledgement of the options disclosure document, the characteristics and risks of standardized options brochure. You can obtain a copy of it here from the Options Industry Council by contacting our website or simply dropping us an email at options@theocc.com. Now, some of the things that we're going to be talking about today, we're going to try to keep it simple. We're not going to be talking about commissions. We're not going to be talking about fees or margins. We're going to keep it simple, and although that these charges do impact your everyday trading account, for our purposes today, we're just going to go ahead and skip over them. But please know that they do exist. Talk to your broker about what they may be. And finally, any strategies that we discuss today, and as well as everything here at the OIC, it's simply for educational purposes. We're not making any recommendations. We're not endorsing any particular strategies or companies. Everything is for educational purposes. And speaking of education, that's what we do here at the OIC. We are all about options education for the individual investor, for the financial advisor, what have you. We are here to provide the education about the responsible use of options education. We do that through our website, optionseducation.org. We are funded by the OCC as well as the regional option exchanges around the country. You can see those here, those being the CBOE, NASDAQ, the Box Exchange, the MIAX in Miami, and obviously the NYSE in New York. So, we receive our funding from those groups, and again, our only product, our only really reason for existence is to provide options education to investors. Speaking of the exchanges, you can see here that the volume from the exchanges really exploded exponentially in the early 2000s, and we really attribute that to electronic trading. Now everybody has access to trade the market, and you can really see how that has impacted volume over the last decade or so. So with that being said, let's go ahead and get into what we're going to talk about today. Here's our presentation outline. I'm going to give a quick, brief introduction of the exchanges and the options industry as a whole before we get into symbology. And what we're going to do with symbology, we're going to look at the different ways to look at an option symbol, to decipher what it is those numbers and letters mean. We're also going to look at how flex options and contract adjustments can affect the option symbol and make it different from what you're normally used to seeing. We're also going to talk about different trading cycles. What months are listed when? What months are going to be coming up? How do weeklies get listed and leaps as well? All of those will come into play with the option cycle. Then we're going to get really into the bread and butter of our presentation as we talk about option chains. We're going to break down what an option chain is and what the material it is that it gives us. What the information is that we can see, and we're going to look at a couple different examples of option chains. So let's go ahead and get started. I hope everybody's sitting down and ready for some fun, and let's take a look at what we have. So when it comes to the exchanges, the CBOE was the first. Was created in 1973, and at the beginning of the dawn of trading, 16 different companies were represented on the trading exchange, on the trading floor, with about maybe 2 or 3 dozen different listings that they had. Well, today, that's blossomed into about 4,200 different listings to trade. And many people often ask us if they can have a list of all of the companies that list options, and we do provide such a resource on our OCC website. So it's called the Directory of Listed Products. You can find it there at that web link. And Alex did mention in his introduction that not only is this slide presentation going to be available for download, but he's provided some of those links for you as well. So you don't need to worry about writing this down. It is provided for you in that download. So the Directory of Listed Products, it tells us various option symbols and the company name, as well as the exchange that the security trades upon, position limit as well. On our website, we also have what we call a series search. And the series search is really a wonderful tool where it tells us every available expiration, every available strike for a specific security. It includes adjusted contracts and flex as well. And while you're there on our OCC website poking around, you'll also find numerous other historical data, new listings, daily and historical volume, open interest information, etc. One of the biggest resources that the OCC provides to investors is the informational memos, and that tells us all about upcoming contract adjustments that result in corporate actions. So when it comes to symbology, when I started on the trading floor about a little over 20 years ago, one of the product that I first started in was the NASDAQ trading pit. And the way that it was back then was if you wanted, if my customer called and said, buy me, 2,000 NASDAQ June 2,500 calls, let's say, I would have to find the exact symbol for that June 2,500 call to put on my trading ticket before I can enter that order into the crowd. And the way that the trading tickets were, the way the symbols were, is the option symbol was based on the strike price. And as you moved a range of strike price, you got a new option symbol. And oftentimes it was confusing as to what that option symbol was, and unfortunately it caused a lot of delays in terms of getting that order out to the crowd in a sufficient period of time. So luckily in 2010, the options industry decided to create a more standardized symbol. And what we are left with, what we have now is what you see here, XYZ 1819A100. Now, that may not seem as intuitive and as simple as you would think, so let's go ahead and break it down and see what it actually means. So XYZ is going to be the stock. That's going to be the underlying upon which the option is based. The next number, in this case 18, that is going to be the year of expiration, while the 19 represents the day of the month that the symbol, or I should say the contract expires. Now, this is where things get a little bit different. The letter represents the month and the type of option, and I'll get into that in just a moment. And then the last number, the 100, that's pretty self-explanatory. That's going to be the strike. So let's get back to that month and type, that letter. What the exchange decided to do, what the industry decided to do, is they took the first 12 letters of the alphabet and they assigned those to the calls for the year. Then they took the second 12 letters and made those puts. So in our example, the XYZ 1819A100, that A represents calls for January. So we've got the January 19th of 2018 $100 call, and the security is XYZ. Now, you may see this option symbol written different ways, but it all means the same thing. Here it's spelled out a little bit more, and you can see some various ways that it all tells us the same thing. January 19 of 2018, the XYZ 100 call. So all of these tell us the same thing. One thing that you may notice, however, is a very common way that people are writing kind of a shorthand option now is the XYZ Jan 18 $100 call. All right, so it seems like it makes sense. It's fairly simple. But what is missing? What's one thing that you notice is missing in that particular option symbol versus the previous ones? Well, we don't know what day of the week it expires. We don't know what that date is. We know from the other symbols that it expires on the 19th, but we don't have that here. So if the day of the month is not specifically noted, it tells us that we're looking at a monthly option contract rather than a weekly or quarterly or end of month expiry. So if no date is listed, it tells us that it's the monthly expiration, which typically is going to be the fourth Friday of the month. So that XYZ Jan 18 $100 call tells us that we're looking at the Jan monthly contract expiring in 2018. Now, when it comes to flex options are going to be a little bit different. Flex options, for those of you that don't know, are negotiable and fully customizable option contracts. Flex options typically are traded by institutional level traders, banks, hedge funds, things like that. And what they're looking to do is they're looking to customize or tailor the option specifically to their needs. They can customize the exercise style, whether it's American or European. They can customize in some cases whether it's AM settlement or PM settlement. They can customize the strike. I used to have a customer that a bank that I did business with that would often quote the SPX 10% out of the money call. And if the SPX was at, say, 242.39, that 10% out of the money call would be 243.9 above where the S&P is trading. So you can actually fully customize a strike price to dollars and cents. So that's where flex trading comes in. So with the flex trade example that we have here, 1XYZ, 4ZYX, well, what does that tell us? The number that precedes the option symbol denotes whether it is AM or PM settled, and it denotes whether it is American or a European exercise. And what we're going to need to know is, are we dealing with an equity, an ETF, or are we dealing with an index option? If we're dealing with an equity or ETF flex option, all of those options settle PM. They settle in the afternoon after the market close. So the numeric value, that 1, for example, or that 2 that precedes the option symbol, refers to the exercise style only. In our example 1 XYZ, it tells us it is an American PM, because it's equity, it's always going to be PM. It tells us that it's an American style exercise settling in the afternoon. With the indexes or the indices, that can expire AM or PM in American or European. So in the example we have for ZYX, we know that it's going to be a European exercise PM settled option. And again, that is all fully negotiable, fully customizable by the trader. That is a flex option. Now, for those of you that joined us earlier in the spring, I know that my partner Bill did a wonderful webinar on the OIC, a wonderful webinar about contract adjustments and how that can affect your option position. One of the things that we learned about is that contract adjustments often lead to a change in the option symbol. Certain stock splits, specifically odd splits or reverse splits, distributions, dividends, spin-offs, mergers, all of those can and oftentimes do result in a change of option symbol. Now, unlike the flex option where the numeric value precedes the underlying, with a contract adjustment, the numeric value comes after the underlying. So in this case, XYZ, as an adjusted contract, let's say it undergoes a reverse split, that option contract is now referred to as XYZ1. And the interesting thing about contract adjustments is that number also denotes the number of adjustments for that contract. There are several ETFs, there are several leveraged ETFs that often undergo reverse splits. I spoke with a gentleman earlier today about one specifically, and we were looking at the third iteration of that contract. In this case, it would be XYZ3, meaning that the option had existed as a standard 100-share contract. Then it was adjusted once, went through a reverse split a second time, so it became XYZ2, reverse split a third time, XYZ3. So that number that follows the option contract, that tells us how many of those splits there were, or how many of those adjustments occurred. And again, back to the OCC, our informational memo section, that is going to give you all of the information that you need to know about the contract adjustments and what that symbol represents. So when it comes to the expiration cycle, now this is something a little bit odd. When options were first created, the markets decided to list them into one of 3 cycles, cycle 1, 2, and 3. January, as you can see, is cycle 1, Feb is cycle 2, March is cycle 3. Then it repeats itself, April cycle 1, May cycle 2, June cycle 3, and so on and so forth. So what the exchange did is they created these cycles, and they said, in order for these options to exist, we need to obviously have certain expiration months available for the trader to trade. So they said, well, let's do this. Let's create, for liquidity's sake, let's make sure that the first 2 nearest term consecutive calendar months, what we call the front months, make sure that those front months are available to trade. So right now we're trading August contracts. August and September would be the front month contracts, and that's going to be available for almost every security out there. Now, for people that want a little further term, they're going to take the next 2 farther term quarterly cycle months. So they're going to go with this chart and look at the next 2 months that fall within that cycle and add those. So those are going to be our 4 months or our 4 expiries available to trade. Now, those of you that are actively trading, especially some of the more popular securities out there, you'll know that we have many more available securities than, many more available expiries than just those 4. More frequently traded securities have many, many more expiries. We've got weeklies, we've got leaps, several other months besides these 4 are listed as well. And I have a note there that it's determined by the exchange, which is a very important thing to note. The exchange is the one who decides which options to list upon which securities. So the company doesn't determine whether or not they're going to list options on their stock. It's the exchange that determines whether or not they're going to list options on a company's stock. The exchange also decides which months or which expiries to offer. They also decide which strikes to offer and which strike increments, whether it's $1 strikes, $5 strikes, $10 strikes, what have you. The exchange is the one that makes that determination. So just a little bit of information there, something important to point out, because we often do get a number of emails with people saying, you know, why don't you list this month and why don't you list leaps on this particular contract? It's not the OCC or the OIC that's making that decision. It's done at the exchange level. So let's look at a couple different examples with options and see what the cycles represent. So here's an example. XYZ is a cycle 2 option. It's now August. What months are available to trade and which will be added next? Well, if we're trading August now, we know that the front 2 months are going to be August and September. We can also look on our chart to see cycle 2 options and see that following September, the next 2 cyclical months are November and February. And that being said, once August comes off the board, well, what's next? The 2 front months would be September, and October would be the following. And because October is not currently listed, October would be the new month that would be added after August expires. Let's look at another example. Cycle 1 option, and we're going to go into the future a little bit. It's now November 5th. So again, which months are available to trade and which will be added next? Well, if we're November right now, our front 2 months are going to be November and December. The next 2 months that follow on that cycle 1 calendar would be January and April. And so after November comes off the board, we would have December and January. Those would be the 2 front months now. April would be the next cyclical month, and the final cyclical month would be July. So after November expires, we would be adding July. And that's how these cycles work. So what you'll need to do is you'll need to know what cycle your option is, and then you can go on the OIC website and you can find our cycle table or our page of cycles, and you can see what months are going to be added next. Now, when it comes to weeklies, weeklies are a bit of a different animal. Weeklies were introduced in 2005, and the reason we have weeklies is to give us targeted trading opportunities. If you want to take advantage of an upcoming event, earnings, let's say. If you want to take advantage of earnings coming in 2 weeks, well, you don't want to buy yourself 45 days worth of value. You don't want to buy an option that's got 45 days worth of time value in there when you're only looking for 2 weeks. So the exchange created these weekly options that allow us to take advantage of a shorter time frame. They represent about 15% of the listings, so not every option has weeklies available. Now, here's something interesting. Weeklies are generally listed on a Thursday. They have a Friday expiration, but weeklies are a bit of a misnomer. A lot of people are under the assumption that a weekly trade is listed, let's say, on Thursday, and it expires the following Friday. That is absolutely not the case. Weeklies generally are listed with expirations 5 weeks in advance. So today's Wednesday. Tomorrow there will be weeklies listed in specific securities. Those weeklies that are going to be listed tomorrow will expire 5 weeks down the road. So the idea of a weekly expiring in a week, like I said, is a bit of a misnomer there. Now, they're not going to be listed if there's already an option existing for that particular day. So they're not going to be listing a weekly contract expiring on a normal monthly or a quarterly basis, something like that. And the weeklies generally exist to expire on Friday. There are several option contracts out there, several securities that have Monday weeklies, Wednesday weeklies, as well as Friday weeklies. And it's certainly not inconceivable to think that in the very near future, weeklies will exist on Tuesdays and Thursdays as well, leading every day to be an expiration day, which is interesting because when I got into business, expiration week, we only had monthly contracts, and expiration week was a big deal to the point where I had to plan my wedding around expiration Friday. So no one was able to take any time off expiration week, and then now here we are 20 years later, and it's expiration is almost a daily basis. Another thing to keep in mind is that weekly options can have different contract specs than their monthly counterparts. The SPX, for example, for those of you that trade it, know that it is an AM settled security, meaning that it settles on the opening print of the morning of expiration, that third Friday of the month, which means the last day to trade the contract would be the third Thursday, the day preceding expiration. With the SPX weekly contracts, it's a different animal. It's a PM settled option, so you have all day Friday to trade the weekly contract, whereas you don't have that option for the normal monthly contract. So just as with everything else when it comes to options, know your security, know the different components of that contract, know those specifications. Very, very important. And the last thing that we're going to look at when it comes to the cycle is leaps. Leaps are long-term securities. They typically expire up to 28 months down the road, and they also are introduced on a quarterly cycle. Cycle 1 options are introduced in September, October for Cycle 2, November of Cycle 3. And again, just with everything else, the exchange determines the eligibility. And then lastly, leaps are available on about 25% of listings, somewhere around 1,000 or so. So not all contracts have leaps, but again, the exchange is the one that will determine whether or not those contracts are afforded or available for you. So let's go ahead and get into option chains now. This is what we're often asked here at the OIC. What are option chains? How do I read them? How do I make sense of them? How can we use them? So, let's take a look. What are they? What do they tell us? And where can we find them? Well, in the simplest of terms, option chains, it's basically a table of information that shows us all of the options available to trade in that security. Simply, as simple as that. It's a table of information. They tell us what strikes are available. They tell us the markets, so live quotes or delayed quotes, as the case may be. They'll tell us the bid and the ask. They'll tell us the size of those markets, volume, open interest, etc. It's just a wealth of information. It's probably the primary tool of the option trader is the option chain. So it's definitely something that we need to get familiar with. And where can we find them? Anywhere. We can find them on online trading sites. Your brokers, their platform should certainly have option chains. And because we're the OIC, we're going to go ahead and look at the OIC's option chain, and that we find on our website, again, optionseducation.org. Now, when we get there, we're going to see this main toolbar at the top, our main menu bar, and in that right-hand corner, we're going to go ahead and type in our symbol of the option that we're looking at. And again, for those of you that have been with us for a long time, you know that XYZ is the fictitious option of choice when it comes to the OIC, so we're going to go ahead and look at the XYZ option chain. And this is basically what we have. So this is the OIC option chain for XYZ. It's going to show us all of this information. And it's a lot of information, right? I know that it can be overwhelming when you first look at it. Certainly, I know the first time I saw it, I was overwhelmed. So, when it comes to anything, the best way to learn is to break it down step by step. So let's go ahead and take a look at a couple different sections here, piece by piece, and see if we can't make out what it is that we're looking at. So let's look at this top part first, and we'll go ahead and just isolate that for you. Hopefully it's a little easier to see there. So this top part is simply going to be our options root and the symbol. That's going to be the option that we're looking at. here's some information below it that we're going to take note of is the price. Well, obviously that's the current price of the underlying. A lot of this is fairly self-explanatory. Now the change in the percent. So that's going to be the change in the price from the previous close. So where the price is currently from where it closed yesterday. So the increase or decrease both in price and in percentage from yesterday's close to the current price. We also are going to be looking at the 52-week high. It's the highest price of the last year, as well as the 52-week low. Again, that's going to be the lowest price of the last year. Stock volumes, fairly self-explanatory. How many shares traded today? We also see the average daily volume. So that's going to be the average daily volume for the past week. And then the average open interest. And open interest is a topic that we're going to get into in just a little bit. But we see the open interest for the outstanding contracts. So this is going to be the average daily open interest for the entire security for that last week. Let's put it all together just as here's going to be a nice cheat sheet for you if you want to reference this later. So this shows us all of the different information that we get on that top section. So again, here's our main option chain, and there's that top section, that we just looked at. Now we're going to look below that at the at, in, and out of the money information. Let's isolate that and blow it up a little bit. So the at the money, that's going to be what we call spot price, or that's going to be the current stock price there, and it's going to be the nearest strike above and the strike below that spot price. That is our at the money. At the money plus out of the money, that's going to be all of the calls above that spot price and all of the puts below. All of the all of the out of the money calls, all of the out of the money puts. So we can click on that if that's what we're interested in, and just if we're just looking at out of the money options. If we're looking at in the money options, we can click this one. That's going to be all of the calls below the strike price and all of the puts above. The one that I usually use here is the near the money. So I'm going to put in a range. I want to see all of the options within 5% of that current stock price, or I want to see all of the strikes 10% within that current stock price. So I'm going to choose that near the money option. I can also select that I want to see just calls or just puts or both, and then I can also obviously select the desired expiration. Do I want to see July options? Do I want to see options only in August or leaps, what have you. So that is our at the money, out of the money section. We've already looked at the top. Now this is where all of the information, or this is where people derive the majority of their information. This is what they look at option chains for. This is going to show us the markets and the available strikes. So here it is a little bit more blown up, hopefully a little bit easier to see. The strike price, that's obviously just the aggregate exercise value. What that means is that if you exercise or assign on your option, you are going to pay or receive your strike price times 100 typically. And in return, you will receive or deliver 100 shares of the underlying, again, typically. So that's what that strike price represents. We've obviously got calls and puts with the underlying as well. Now, the information that's coming up now, the bid-ask mean. Now, what that is, that's going to be the mid-market average between the bid price and the ask price. A lot of investors, professional traders, individual investors, what have you, they use that bid-ask mean to help them determine the value of the option. They take that midpoint between the bid and the ask, and they use that as a starting point to negotiate their option buying or option selling. When it comes to buying an option, you can only buy it for what somebody's willing to sell it for. When you want to sell an option, you can only sell it for what somebody's willing to pay. So, those don't necessarily have to be absolutes. As we can see here, on that top option, the 230 call, for example, hopefully it's clear enough for you. You can see the market is 1224 at 1241. Those are the bid and the ask. Now that doesn't mean if you're buying the option you have to pay 1241, or if you're selling the option you have to sell it at 1224. What some people will do is they will use that mean, that average price, and use that to begin their negotiating process. They may put an order in to sell at $12.35 or $12.30, or they may put an order in to buy at $12.30 or $12.35, what have you. So they use that mean as a starting point to negotiate. And then again, like I said, that bid price is the market at which or the price at which the market is willing to buy, where the ask is the price at which the market is willing to sell. Now, the change button here, this is something that is a little bit tricky, because this is the difference between the last trade and the previous trade. Not every option trades every day or every hour of every day. So you may have an option that the last price was from yesterday or 3 days ago or 3 weeks ago. So that that change that you're seeing, that's going to be from the last trade to the previous last, that may not necessarily be relevant. So, a lot of people may look at that price and kind of take it with a grain of salt. It's obviously, up to you as to the importance that you put on it. Volume, obviously, self-explanatory, the number of options that traded currently on that particular strike for the particular day, and then open interest. Now, open interest is it's one of the more misunderstood concepts. Open interest, it's the total number of contracts from one day to next. Now, what does that mean? At the end of the day, after all the exercises and assignments have been processed, anything left on that contract, anything of those positions that are left, is considered open interest. Those are open contracts carried from the close of one business to the open of the next. Those are the overnight positions carried. Now, why do people look at it? Why is it so important? Well, some people think that it can be used to spot trends in the market. Others think that it, may be a bit misleading, because maybe you see increasing open interest and you think that it's a bullish indication, but not necessarily. What if it's puts? Obviously that would be bearish instead. So open interest, it certainly can be misleading, and let's look at and what we mean by open interest and how it works. So with every option transaction, there's going to be a buyer and a seller. If the buyer is opening a new position and the seller is opening a new position, or if they are simply increasing an existing position, then that open interest is going to increase by a factor of 1, or it's going to increase by 1. If I'm buying to open and you're selling to close, then there's going to be no change in the open interest at all, and same thing vice versa. If I'm buying to close and you're selling to open, there's going to be no change. So open interest only increases or decreases when both the buyer and the seller are opening their contract, or both the buyer and the seller is closing their contract. If they're both opening, open interest is going to increase by 1. If they're both closing, it's going to decrease by 1. So that is open interest and how it works. And you can certainly, for more information on that, if you wanted to, give us a shout out at the OIC via email, we'll, be happy to discuss that a little bit more for you. So again, here's our cheat sheet with the option chain, and let's go ahead and look at this last section, which is going to be implied volatility and the Greeks. Now, because this is a beginner fundamentals option course, we're not going to get too deep into these more intermediate or advanced concepts, other than the fact that they do exist on our option chain. I'll give you a brief explanation about what they are, and again, if you have further questions about that, you can either look at some of our previous material that we have on the Greeks, or we certainly have a wealth of it on our website as well. So let's start out with the implied volatility. Implied volatility, that's the market's estimate of the future volatility of the underlying derived from the options price. Now, what does that mean? Well, when it comes to options, there's two components of price. If you remember from last week, we had the intrinsic and the extrinsic. Intrinsic is known; it's the stock price and it's the strike price. Extrinsic, the known items there are time value, dividends, interest. Those are all known. The only unknown when it comes to an option price is volatility. So that is going to help determine that option price, because you have an idea of what's going to happen with the stock. I have a different idea of what's going to happen with the stock. Together we come up with the price of the option, and the volatility is derived from that. So implied volatility is on there. That is the estimate of future volatility, and it's derived from the option. We also have delta. Delta is a very, very common Greek that a lot of people are familiar with. That is simply going to be the change in the option value versus a $1 move in the underlying. If an option has a 45 delta, let's say, and we're talking a call, and the stock moves up $1, that option is going to change in price. It's going to increase in price. All other things remaining constant, that option is going to increase in price by 45 cents. Gamma is going to be the change in delta as the security moves by $1. So delta isn't constant. Nothing in the market is really constant. That change in delta is going to be known as gamma. Theta is something that people often encounter and something that is very, very popular as a Greek. That's going to be the time decay. We talked about how time value is one of the components of price. So as that time decreases, the value of the option increases as well. And it's not constant. As we approach expiration, that rate of change, that rate of decrease is going to increase. It's going to accelerate substantially to where at time of expiration, that amount is zero, meaning that there is no time value left in the option at all. So that is represented by theta. Alpha is certainly for our purposes a very rarely used Greek. It's simply the ratio of gamma over theta. Some people look at it as, or they call it an active return. What the value is of that option, how much they're making on it that specific day. It's like I said, it's definitely one of the more advanced concepts, and it's something that not a lot of people look at in the beginner or intermediate stages. Vega is going to be a change in volatility, the option change as it relates to a percentage change in volatility, while rho is interest rates, the rate of change of the option as the interest rates move. So again, here we've got our cheat sheet showing everything of the option chain, and then lastly, our option chain collectively. Now, let's go ahead and just take a look and make sure that we can read this together. So if we were to look for a specific price, at what price could we buy the July 232 put? So how would we use this option chain? Well, first we're going to make sure that we've got the right month. So we're looking at July expiry, so that's what we want. That's good. Let's look at the 232 strikes. There we have that. Our calls are on the top, the puts are on the bottom. And because we're looking to buy the option, what do we want? Should we be focusing on the bid or focusing on the ask? Well, naturally the ask, right? We can only buy at a price at which somebody is willing to sell. So we're going to be looking at that ask price there. So at what price could we buy the 232 put? We could buy it for $1.23. And again, that's not to say that that's our limit price. We can possibly buy it better. One thing that this chart doesn't show that a lot of people find very, very useful is bid size and ask size. So we can buy that option at $1.23, but how many can we buy? Can we buy 5? Can we buy 50? Can we buy 500? So bid size and ask size is definitely something to consider. Certainly if you're looking to buy a good number of contracts. As an index broker for many, many years, we dealt with what we call size. Most of our contracts were 500, 1,000, 2,500, what have you. There were times when my customers would call and ask me to go into the equity crowd and buy 50 options. And with my index mentality, I'm thinking I can get them all done for the same price, and it would turn out that I could only get 5 done for, in this case, $1.23. I'd have to buy another 10 for $1.24, another 10 for $1.25, and et cetera, et cetera. So while they were offered at $1.23, it was only a small number offered, and my average price ended up many times would come out to $1.27, $1.28, what have you. So bid size, ask size, definitely very important. If you're looking to trade, more than just a couple contracts. Well, let's look at deltas. So if XYZ were to increase by $2, how much would our July 230 call increase? So again, let's make sure that we're looking at the right month. Again, let's make sure that we find that 231 call. And unfortunately, I gave it away a moment ago with my comment about delta, but that's what we're looking for. If the option increases by $2, what is the statistic? What is the indicator that we're going to be looking for that tells us how that option would change, and that would be delta. So with our delta of just under 0.8, if the option rises, if the stock rises by $2, how much would our call increase? And the answer is about $1.60. So just wanted to make sure that we're all able to read that option chain and know where to find the right information. Now, that's the OIC option chain. There are many, many different trading platforms out there. Your broker certainly has one. Many different trading firms have some as well, and they all look different. While the information is all the same, it's just presented in a different way. So let's go ahead and look at another one. And this one is slightly different than the previous in the sense that we've got our calls on one side and our puts on the other, as opposed to before we had one on top of another. So calls are on the left, puts are on the right, and this is, again, a typical option chain, what you would see. We've got all of our underlying information there at the top, showing the stock prices and such and volume. We've got all of our available expiries underneath it as well. So you can see everything is pretty much the same. Now, depending on your trading platform, they also, in addition to a standard option chain, they may have some variations of that depending on how sophisticated that trading platform is. Now, one of the things that I like very much is if it has what they call a call matrix. And what the call matrix does is it shows you all of the available calls for all of the available expiries, and it's all on one table. So if you know, for example, that you want to buy some calls, but you're not sure if you want to buy near-term or long-term, it immediately shows you what the price for those options would be based on the additional time. The more time that you get, the more it's going to cost you. The proverbial time is money. Obviously that's the case in options as well. The more time we want, the more it's going to cost us. So if you're looking at spending a fixed amount of cash, here with this call matrix, you can find something that maybe fits your idea, fits your strategy, fits your forecast. So let's take a look at how we would use this. What is the approximate value of the September 235 call? Well, just like our option table before, we're going to make sure that we're in the right month. So there's our September options. We're going to look for the 235 strike. There we have that. And we've got a price of $9.90 at roughly $10. So the approximate value, remember we were talking about that mid-range, that mean price, kind of go between the two. So the approximate value of that September 235 call, $9.95. Some of the other option chains that your broker may make available is they may have one specifically for delta and applied volatility. So you can see you have that, all of that on one chain next to each other for the calls. Same thing for the puts. So delta and applied vol is a fantastic chain that people like. Now, one of the ones that's my absolute favorite, and not every trading platform has this, hopefully yours does, is covered calls. Now, a covered call, as many of you will know, is one of the more popular investing strategies out there. That's where you buy 100 shares of stock, you sell one option against it. And the idea being is that you generate income from the sale of that option, and then if that stock gets called away, you're also going to benefit by the appreciation of that share price, plus that call, it just adds to your profit. So with this covered call matrix that we have here, we've got the net price of the strategy, which is going to be the share price minus the option premium. We also know the premium in relation to the strike. Many people, when they're putting a strategy on, may say, well, I want to go ahead and put on a covered call where my option is less than 1%. The premium is less than 1% of the strike price. So you have that there as well. It spells that out for you, so it's a little easier for you to figure out without doing the math yourself. Now, what I really like is these next two categories here, your return if assigned and the return if unassigned. So if unassigned, your return is simply going to be your option premium that you receive, right? The stock doesn't get called away, and your entire profit is going to be that option premium. The return if assigned is going to be that option premium, but it's also going to be the appreciation for the stock price. So if you look, for example, with the 248 call, right now stock is trading about $242. So that 248 call, if our option gets assigned, that means that the stock price typically is going to be more than $248. So we've made $6.
Hello, everyone. I think we might have lost Mark. So with that, while he tries to figure out how to get back in, wanted to give everyone a shout out to the Options Education Program. If you want to continue your education, you can visit us at optionseducation.org. And then you can check out our different courses and podcasts. You can take the My Path assessment, so you can place yourself at your own skill level and participate in the online courses that we offer on our website. You can also get all your options-related questions answered by our leading professionals at Investor Services. If you have any questions, specific questions, you can reach out to them at options@theocc.com. That's app options with an S at theocc.com. And for more information, like I said, you can connect with us on our website at optionseducation.org, and then as well as follow us on Twitter as to join the conversation. Our Twitter handle is at options_edu. I think Mark will attend here. He's going to take over and take any questions from the audience here.
Hey, everybody. Sorry about that. We had some technical difficulties here. Luckily, we were right at the end of our presentation. So we do have some time. Let's see, we talked about the returns. So returns if assigned, hopefully you caught that. The returns if assigned are going to take into account the increase in the stock price as well as that option premium. So it's just a feature on this particular option chain that I think is really, really terrific. And if you're interested in covered calls, our OIC website, we do have a terrific covered call calculator for you to take a look at that will also compute this information for you. So question-wise, let me just go ahead and sort through some of these. Here's a question that, that I should have addressed, and I apologize that I didn't. Question from Tom. How can I tell if my option is cycle 1, 2, or 3? You know what, Tom, I apologize. That's certainly something that I should have addressed. And unfortunately, there's not a very easy way to do it. We certainly wish that something was a little bit more seamless. But what we do here at the OIC is we go on the CBOE website. The CBOE publishes a directory of all of the securities that they list options upon. And as part of that list, they denote whether the option is cycle 1, 2, or 3. So you can go on that list and type in whatever it is that you're looking for. It'll tell you what cycle that is. Now, what do you do with that? Well, once you have that cycle information, 1, 2, or 3, then you go on our OIC FAQ page, our frequently asked questions page, and we have a tab for leaps and option cycles. And what you'll do there is you'll click that on, and it will show you various tables showing that when August expires, if your option is cycle 1, then this month, whatever month it may be, is going to be listed. If your option is cycle 2, this month will be listed, cycle 3, etc. So that's what we do here at the OIC. We go to the CBOE website, which is cboe.com. We get that information, and then we go on our OIC website. So I hope that answered your question, Tom. Let's see what else we have. It looks like Carol is asking us about open interest. And Carol, this is a good question. She's saying, you mentioned that open interest can spot trends. How does it do that? So, Carol, the thing about open interest, we were talking about, bullish versus bearish. What some people feel, there's a couple different schools of thought. One of which is if open interest is increasing, and prices are increasing at the same time, right? So you've got to have both. Then that indicates a bullish trend. Rising open interest, rising prices. Rising open interest and decreasing prices would indicate a bearish trend. So some people use open interest to spot bullish or bearish trends. Now, the reason I say it can be a little bit misleading is, well, what if that open interest represents puts? So if a lot of people are buying puts, the price is going to increase, the open interest is going to increase. But as you know, when people are buying puts, that indicates a bearish bias. So that's why I'm saying it can be a little bit misleading, because we don't know if it's calls or puts. And we also don't know the reason behind the buying or the selling. For example, a lot of companies, if they're doing like first of all, if they have a long stock position in their own company, or if they're doing a stock buyback, what they may do is they may trade puts. If they've got a long stock position in their company and they want to protect that against, some market trends, they may buy puts against that stock. Now, that doesn't mean that they're bearish. That just means that they want some downside protection. So the open interest may not apply in that case. Another situation would be if a company is buying back their stock, they may sell puts against it. And the reason being, if they get assigned, well, they're planning on buying the stock anyway. So that's going to affect the open interest as well. So how can it spot trends? Well, it can spot trends depending on how it correlates to the price. But like I said, it can be misleading. So you're definitely going to need to do your homework with that. Let's see who else we have here. Let's take a question from Rushton. And Rushton is asking, can individual investors trade flex options? Well, can individual investors trade flex options? That all depends. In my experience, they could. Typically, flex options are for institutional traders, but individuals definitely could. And what they would need to do, the process, is they would need to contact their broker. Their broker would then submit what's known as an RFQ, which is a request for quote. They would RFQ the exchange, and the exchange would then ask the trading crowd, for a quote for that specific flex option. And all the terms would need to be known. You need to know if it's AM or PM, need to know Euro or American style exercise. We need to know what strike price, the quantity, et cetera, et cetera. So all of that information would need to be known. Your broker would submit the RFQ to the crowd. They would respond with their market, and then from there you can decide whether or not to trade it. So that is how the flex options would work. Now let's see, we got time for one more question. Here's a question: what is the difference between assigned and exercised? Assigned and exercised, when you exercise an option, buyers exercise, sellers receive assignment. So the buyer of a call, basically exercise an assignment, that's when you're making the terms of your contract good. You're exercising your right to buy those shares of stock at the strike price that you had purchased the call for. On the other side, the seller is going to accept the obligation for assignment. So buyers exercise, sellers get assigned. Buyers have rights, sellers have obligations. It's, if you're new to options, it's a phrase that is going to be drummed in your head again and again and again and again. Buyers have rights, sellers have obligations. Buyers can exercise. That means that they want to fulfill the terms of their contract. Sellers have the obligation to make sure that those terms are fulfilled. So that's the difference between the two. And it looks like we are just at an hour. So again, thank you for your time. I'm going to turn it over to Alex, and have a wonderful day.
Thanks, Mark. Ladies and gentlemen, thank you for your time today. And again, we do apologize for the technical difficulties. While we weren't able to get to all your questions, we have our investor services desk ready to help. Feel free to reach out to them at options@theocc.com. And for those interested in further options education, as I mentioned, please visit optionseducation.org, the OIC's website, and see the Getting Started section for further reading. And for the latest and greatest that OIC has to offer, be sure to connect with us on social media. To join the conversation, use the hashtag OIC Education. And of course, be sure to check out optionseducation.org in the upcoming weeks for our next online sessions. And thank you again for attending, and we hope to see you again next time.